Social Security, fact or fiction, right now on Retiring Today. Hi, I'm Molly Nelson here with Sean Honkamp and Loren Merkle. They're both certified financial fiduciaries and certified financial planners. Sean is also a CPA. Today we're playing a little game of Social Security, fact or fiction. So Loren and Sean each have their signs here. Let's see those signs.
Got it.
Fact or fiction. And when it comes to Social Security, we want to make sure you know what is fact or fiction because, Loren, this is such an important part of retirement.
It's a huge decision, and this decision comes with a lot of complexity and a lot of confusion because if you talk to your peers, your coworkers, your siblings, your friends about what is the right Social Security decision, you're going to have somebody say, well, you don't know how long you're going to live. Social Security is going broke. Take it while you can. And then on the flip side, you're going to have somebody, you're going to live forever. You get an 8% guaranteed increase on your lifetime Social Security benefit from full retirement age all the way up to age 70. And you don't have a personal pension anymore. This is your personal pension alternative. You might as well get the most out of it you can. And then there's you in between saying, what do I do? Take it early, take it late. You have up to 81 different options when it comes to electing your Social Security if you're a married couple. Now, if you're a single individual, you don't have 81, but you still have a ton of options. And 12 months after you make your Social Security election, this becomes a permanent decision. So the stakes are high. You have to get it right. You get one shot to get your Social Security and many other retirement planning decisions right. So you want to make sure you have all the information at your disposal to make this decision.
Let's talk about 2025. Some of the numbers for 2025. COLA, the cost of living adjustment, up 2.5%. That'll add about $50 to those monthly benefit checks for most people. The average monthly benefit in 2025 will be about $1,900. For comparison, the COLA in 2024 was 3.2%. The COLA in 2023, those who are on Social Security remember, was 8.7%. The earnings test for 2025. Sean, the earnings test is one of those things that is kind of often overlooked and definitely needs to be talked about.
It's something we have to be aware of and thinking about as we help people make your Social Security decisions. So what the earnings test means to you is that if you choose to elect and start Social Security prior to full retirement age, which for most people is age 67, some people it's 66 in a few months. But if you were to start your benefit prior to then, you've got to be aware of this earnings test. And what it says is that if you're going to make more than $23,400 in the year of 2025, then you're potentially going to have some of your Social Security benefit reduced and taken away from you. So we have to be aware of this earnings test as we help make that decision and know that, hey, if there's part-time work, which is common for a lot of people, they see themselves retiring and going and doing something fun, we've got to be aware of that earnings test, and that amount can apply from age 62, which is the earliest age for most people to start Social Security, all the way up until full retirement age.
Yeah, and that's a really important point because today a lot of retirees are phasing into retirement. They're just not going cold turkey, working one day and then not working the next day. So they are working part-time, and if they're making over that earned income limit, then they're going to lose some of their benefit. But there's a really little known exception to this rule, which means January 1st of the year that you obtain your full retirement age, that earned income limit increases from the $23,000 number that Sean said up to over $62,000. So in the year that you obtain full retirement age, you can actually make way more than what you could those previous years and take your Social Security benefits. And then of course, once you obtain your full retirement age, you can make an unlimited amount and not have that earned income test applied and lose any of those benefits. So you can make money and get your Social Security payments.
Okay, I'm already learning lots of Social Security facts, but you guys ready for some fact or fiction?
Alrighty, let's
do it.
go.
Okay, I'm going to read some statements, and then Loren and Sean will let us know with their signs whether it's a Social Security fact or fiction. Statement number 1, Social Security will run out of money before I retire. Fact or fiction?
I'm going with fiction.
Got fiction. Also, but really, I mean, this one could be an opinion. Do we have an opinion card?
You hesitated. I saw you kind of both hesitate there.
Well, because Sean and I, or Merkle Retirement Planning, or you don't control the federal government, and we don't make their legislative decisions. Although maybe
there's some times we'd like to advise them.
we would certainly like to
Yeah.
at times. So we can't say in depth, we can't promise that it's not going to go away or that the benefits won't be decreased substantially. However, in our opinion, in my opinion, we feel like there's a lot of levers that legislators can pull to shore up Social Security that they are not currently pulling. Just an example is right now only up to a certain limit is your income taxed at the Social Security level, which means there's a whole bunch of income that is not going towards shoring up that Social Security limit, or they can increase the full retirement age and a litany of other changes that they could make. I think also, if they were going to make changes to those who are already on Social Security, like decrease their benefits, or those who are within a few years of electing, if you're in that group, you don't have time to account for that. You don't have time to adjust. We at this table have time if they're making changes to us, which there are plenty of changes they can make, and certainly our kids have plenty of time to make adjustments in their overall plan to account for the decrease of Social Security benefits. So I could definitely, there are changes coming. There's going to be big changes coming, but I think for those who are close to taking it or already on it, their benefits are going to remain substantially the same as what they are now.
Yeah, and the reason this is even a statement that goes along with Social Security is because I think the latest study that I read was that they can, as of right now, if no changes are made, they'll be able to pay the benefits out in full just through 2035. So if you are just about to retire, getting ready to retire, that 2035 doesn't seem that far away.
It's not that far away. It's going to be here before we know it, and that is a really scary proposition because 40%, and this is according to the Social Security Administration, 40% of retirees, older retirees, only have Social Security. That's all the income they have coming in. So if you're a part of that group and you're looking at maybe that being decreased by 25%, you're already wondering how you're going to make it. That just makes it worse. And for a lot of people, Social Security represents 25 to 30% of their retirement income, another big source for them that could potentially be decreased. So it's scary. But I think for a lot of different reasons, those who are close or on probably are going to be okay.
Statement number 2. Surviving spouse at full retirement age or older generally gets 100% of the worker's basic benefit amount. Fact or fiction?
Fact.
Fact.
There's a key word in there that I would say is generally, because I would say this is probably the least understood aspect or benefit that's out there when it comes to Social Security. So when you think about the survivorship impact, obviously we've gone through a life event and somebody has passed away. And when you're at that stage of life, if that's part of your journey, now there's various factors that come into play that can determine what that survivorship looks like or what options or decisions are now in front of you. So let's look at just a simple example. Married couple, they're both receiving their benefit and somebody passes away. That's probably the simplest survivorship impact or survivorship option. They're going to look at both benefits and essentially the survivor is going to retain the larger benefit because you're both already receiving benefits. But now there's a whole array of different scenarios that can be based on the ages of the person that passed away, the age of the survivor. It's whether or not one or both of you were receiving benefits, whether you're married at that time, whether you were divorced. So there's a whole suite of different factors. So it's a very complicated decision. So the biggest thing that we can say is when someone does pass away, you're going to want to lean on somebody, go to a trusted advisor, or certainly reach out to Social Security because they're going to have to provide you with a lot of information that determines what you need to be looking at and decisions that need to be made.
And if you get remarried, that changes things too. So sometimes you're looking back at your current age, but then if you get remarried, that can change your benefit as well.
Yeah, you get remarried and then you get divorced. That can change things also. Or you get remarried and then your spouse passes away. Can also alter the options that you have. So, and this is one of the most confusing parts because some people get survivorship benefit mixed up with spousal benefit, and the maximum spousal benefit people are eligible for is 50%, whereas the maximum survivorship benefit that people are eligible is the full 100%. And both of those, if you plan for it, can have big, broad implications, positive benefits in your overall retirement income plan if you account for the spousal and or survivorship benefits.
And that leads well into statement number 3. An ex-spouse's benefit comes out of your own benefit. Fact or fiction?
Fiction.
Fiction it is. The fact is that if you're divorced and you claim a spousal benefit off of your ex-spouse, not only does that not come out of your benefit, it doesn't come out of your ex-spouse's benefit, and your ex-spouse will never be notified by the administration that you are claiming off of his or her Social Security benefits. So the ex-spousal benefit can improve your situation if you qualify to receive that ex-spousal benefit, but it's not going to impact yours and it's not going to impact your ex-spouse's.
We'll continue playing Fact or Fiction, Social Security Edition, and we'll answer a question that we received recently during our online Journey to Retirement workshop in a segment we call Your Journey, Your Questions. Next. Welcome back. It's time for Your Journey, Your Questions. This is when we answer questions we've received recently during our online Journey to Retirement workshop. Here's a question we got. If I'm single and I don't have dependents, do the people I leave money to have to pay a higher tax rate? Susan N wanted to know that. Lauren, what would you say to Susan?
I would say maybe, Susan.
Okay. Great.
like
Why don't you put Fact and
both.
Fiction up too then while you're at it?
And perhaps maybe Susan has been reading some recent Iowa state legislation.
Perhaps she has.
And maybe that spurred the question because I guess it depends on when you're going to pass away, Susan. Because if you pass away prior to the inheritance law changing in the state of Iowa, in fact, you don't leave money to your dependents, your kids, because you don't have dependents, but you leave it to your cousins, you leave it to your siblings, maybe even your parents. There could be an inheritance tax applied by the state of Iowa because you're not leaving it directly to your kids or grandkids. However, in the year 2026, the state of Iowa has said that inheritance law is going away. So if you pass away 2026 and beyond, while that law is not in existence, not on the books in the state of Iowa, then they wouldn't have to pay that inheritance tax. However, there's multiple types of taxes that your beneficiaries can pay. And right now we're just talking about inheritance tax, but they could pay income tax if you have IRA money that's never been taxed before. You leave it to your kids, you leave it to your cousins, you leave it to your parents. Whenever they take money out of that IRA that's never been taxed, they will have to pay taxes at their ordinary income tax bracket. So if you have somebody who's maybe at the end of their working career at the highest wages they've ever made before, and you leave them an IRA, they have to take it out within a 10-year period of time and apply that to their tax brackets in addition to their earned income, then maybe they pay more tax on that money than what you would pay while you're alive in retirement. So there's a lot that goes into this, Molly. I could tell by your face that there's a lot to follow and a lot of if-thens.
Well, and that's why you can't just say, yes, this applies to you. It's very situational, as with a lot of the aspects of retirement planning. And speaking of situational, I know, Sean, a lot of the families that you guys sit down with, they want to leave a meaningful legacy to their kids and grandkids or nieces and nephews, but they also don't want that meaningful legacy to get eaten up by taxes. And that's when sometimes, if you start talking about this early in the planning process, you can do some things, make some changes to their legacy plan that can really get that money to those dependents in a more efficient way.
Yeah, the legacy plan is part of this overall process that we take people through. And yeah, for those of you that have those goals of you've saved well, you've got a big net worth, lots of retirement savings. And one of those goals is to take care of that next generation and leave a meaningful legacy to your children. Often you are worried about, well, how can you be the most tax efficient with those dollars and strategies. And one strategy that we talk about often is an IRA relocation strategy. So if you've saved really well, you've got a certain amount of guaranteed income. For some of you, it can make sense to take a certain amount of these IRA tax savings. It's going to want to be an amount that you feel comfortable that you're not going to need to get through your retirement journey. You can take these distributions, take a lump sum, and often now turn it into a life insurance strategy where maybe you took a lump sum. Let's just use $100,000. And if you're really trying to create that much more of a legacy, you can turn a lump sum like that into a much larger number. We talk about this as the IRA relocation strategy. So it's not going to be a good fit for everybody. You know, not everybody can comfortably sit here and say, I've got way more money than I need or ever want to spend. But there are strategies like this that can help people be more and more efficient and better position you to achieve all of your retirement goals.
And we talk about that specific strategy in our online Journey to Retirement workshop with our hypothetical couple, John and Sue, where they do just that. And we show you specifically what they take out of their IRA, how much they take out, what they do with it, which insurance strategy they apply to it, and then what it magnifies too. And essentially what it does for John and Sue is they pay less tax on the IRA distributions when they take it out, and then it magnifies, really triples the benefit that is received by, in this case, their kids tax-free. So extremely powerful if it applies in your situation and done right. But the key, Molly, like you mentioned, is you have to plan ahead. This is not something you can just stumble into retirement and then be like, one day, I don't need this money, so I'm going to do this, right? You need to have a coherent plan that all works together, that you specifically identify, this is the strategy that works for you. This is why, and you feel really confident about those decisions.
We've got more Social Security Fact or Fiction next. Welcome back to Retiring Today. I'm Molly Nelson here with Sean Honkop and Loren Merkle. We are playing Social Security Fact or Fiction. I'm going to read a statement. Sean and Loren are going to let us know if it's fact or fiction. Next statement, Social Security benefits are all I need in retirement.
Fiction.
Fiction.
Fiction. Social Security is set up for most households to provide generally around 40% of their income need in retirement. And then people can fill in the rest if for pensions. I know fewer and fewer people have pensions out there, but that's what the retirement savings are meant for. So now you can work in this guaranteed income, which is great. The more guaranteed income you can have, that's why making that Social Security decision is such an important decision. And now you can fill in the quality of life, whatever you need, by using these balances, taking distributions at the right time. So most people are going to want it to have much more than just Social Security as part of their income plan in retirement.
Next statement. You guys ready?
Ready.
I won't pay taxes on my Social Security benefits. Fact or fiction?
Is this a trick question?
It feels like it.
You guys know the answer now?
I think it is.
Maybe a little bit of both.
Okay, explain, Loren.
There are many people who don't pay taxes on their Social Security income, but it's going to be dependent upon what other sources of income that they do have. Also your tax filing status, if you're filing single or filing married. And if you're filing married and you make a little bit over that $42,000 of income per year, then up to 85% of your Social Security income can be subject to tax. But if you're below that income threshold, it's potentially 0% of your Social Security income is taxed. This is also where planning comes into play, because if you incorporate a really good tax plan, and the earlier you start, the better, because the more opportunity you have to do this, you can present a situation for yourself where you have all the income that you need in retirement to live the lifestyle that you want to live, but the vast majority of that income is tax-free, which means that you could be underneath that threshold, so less or even 0% of your Social Security income is subject to tax. But again, that doesn't happen by accident. You have to think in advance. You have to have a well thought out plan and execution strategy to put yourself in that position. So it's possible, and some people do it, but other people are going to pay taxes on their Social Security income.
And so many people we talk to, one of the main goals you have is you want to be as efficient as possible with all these assets. This is another great example of where we need that time for the plan. And if you can do the right things over time, maybe do certain things prior to starting Social Security, that puts you in a stronger position. Everybody out there wants to pay less in taxes. This is a great example of implementing certain strategies. Having a certain amount of time can help people pay less in taxes.
Statement number 6. My Social Security payment is based on my top 35 wage earning years. Fact or fiction?
I really like that
A
one.
good
That's
one, nice
fact.
and simple one.
Yeah, because this can be really confusing, because a lot of people's pensions are based on their last 3 years or the average of the last 5 years. And then here comes Social Security, and they're actually record keeping the last 35 years, actually not the last, your top 35 wage earning years. And this is important to know, and we can model this out. We do this for our families and individuals that we serve, is if you have some zeros, so you haven't worked the full 35 years. So you have zeros that are going into that equation. What if you work 1 more year or 2 more years? Get rid of some of those zeros. How would that impact? How would that increase your Social Security benefit? But first, you have to know how Social Security is designed, which is the top 35 years over your entire earnings history.
And that's great information to have before you make your Social Security decision. Number 7, fact or fiction, the annual COLA is guaranteed.
Fiction.
Fiction.
Again, I think it depends how you look at it. You are getting a COLA every year, but sometimes that COLA might be 0. So it kind of feels, Smiley, I feel like you're trying to trick us up. So there's no
crafty.
Yeah, there's no guarantee that we're going to see a COLA adjustment every year because, as we've talked about, some of those years are zero. But it's something we all look forward to. It just came out recently. We already talked about what 2025 is, what the increase is for 2025. But yeah, it's something everybody looks forward to. It's nice to have a increase in that guaranteed income that is part of everybody's income plan.
Yeah, I looked up some information, guys. I'm locked and loaded here, ready to go. 2010, 2011, 2016, no COLA due to deflation those years. The average cost of living adjustment over the last 15 years, 2.3%. The largest COLA ever, 14%.
Back in the 80s.
In 1980.
There we go.
That 2023 COLA, of course, we talked about that, 8.7%.
Yeah, and the average is right. Over the last 15 years, a little over 2. Over the last really 35 plus years, a little bit over 3. So that's going to change. But I think the main point around the COLA is it is there. It can help, but it is not going to fully account for inflation and certainly not going to fully account for the retirement taxation that you're going to experience. That's where all of the income planning needs to come into play to work hand in hand with your Social Security decisions and income.
This is Retiring Today, and we thank you for watching.